The biggest change in the last few years regarding divorce or separation agreements executed after 2018 is that alimony amounts are no longer deductible. Recipient spouses are also no longer required to include alimony payments in their gross income. For divorce or separation agreements executed before January 1, 2019, the opposite is true. Alimony is deductible by the payer, and recipient spouses must include such payments as gross income. It's important to remember that alimony is not child support, nor is it voluntary payments or payment for upkeep, use, or dues on property. Alimony is a separate court-ordered allotment awarded to a former spouse as financial support following a separation or divorce. A spouse who served as the primary child rearer of the family or who made significant sacrifices to their earning potential in order to support their working spouse may be granted alimony to help them transition out of a marriage and establish themselves as an independent earner again. While different states have their own unique laws regarding the issuance of alimony, the way taxes are calculated is universal. If the divorce is new, neither payer nor payee will note alimony payments on their tax returns for 2021. If the divorce was finalized in 2018 or prior, the payments must be factored into their taxes for 2021. A divorce or separation agreement for alimony that was modified after the deduction repeal date should state whether the modification observes the new rules or not. Alimony paid before 2019 is entered on line 18B of the taxpayer's 1040 or 1040 SR. Payers are not allowed to use the 1040 for nonresident aliens and those who must file as representatives of deceased persons or estates. Payees who receive the alimony, however, may file any of those three forms, depending on extenuating circumstances. The Social Security number or individual taxpayer identification number of the former spouse must be provided or either party may be penalized $50. Whoever failed to provide the proper number is the one liable for the penalty. Warn your clients of this fact. Please also be aware that different rules apply to the reporting of alimony depending on if the agreement was executed before or after 1985. What qualified as alimony back then is not the same as it is now. Taxpayers who are still paying alimony from before 1985 will have drastically different criteria and taxation rules to follow than those who filed for divorce in 2020 and 2021. Refer to the 2004 version of Publication 504 to help these taxpayers file. Still on the topic of alimony, there is a 3-year recapture rule that applies in different ways to payees and payers. If payments decrease or end within the first 3 years, the IRS will reclaim the previously deducted amount, and the receiving spouse can deduct part of the alimony that was included as income in the 2 years prior. Reasons for such a change may be a change in the divorce or separation agreement, a failure on the payer's part to make timely payments, a reduction in the payer's ability to provide support, such as loss of steady employment, injury, etc., or a reduction in the spouse's need for their financial support. Worksheet 1 in Publication 504 can be used to determine the recaptured amount. Recaptured income is reported on line 2A of a taxpayer's 1040. Deducting a recaptured amount is shown on line 18A. In both cases, cross out the word received and instead write in recapture.